You're listening to Real Investor Radio with Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. All right, we're live. Welcome back to Real Investor Radio with Fuhr and Jack Bevere. Jack, good to see you.
Great to see you, sir. Good morning.
Man, we're going around the horn today doing some quick hits. Hope folks like these. Jack, we get calls, every day from real estate investors around the country. Some who are, mom and pop, own a few houses, want to grow the portfolio, fix and flip guys. We do loans, everything from, $100,000 up to $5 million, Jack. And so we talk to folks every day. The phone rings off the hook here at Dominion, thankfully. And lately, I wouldn't say it's a ton, Jack, but I get a lot of people that are on the fence with regards to interest rates. What's the Fed doing? We were promised 3 rate cuts this year. We're not seeing them. They appear to be on the fence. And what's happening is, we'll send out a loan quote and they're the rates are the rates. And so they're like, well, we're probably going to wait for a bit and see how things go over the next several months because we think there's going to be a rate cut. And so, let's have a quick discussion about that, Jack, about, we're obviously in election season and, what do you see coming down the pike? You're one of the smartest guys I know, so I think you have an opinion.
I do have an opinion. It's often wrong, but yeah, I got an opinion. So I got really excited everyone got really excited at the beginning of the year because Powell came out and gave his 3 rate hike in 2024 speech, which was like a dramatic reversal on all of his posturing previously, which was very, very hawkish.
Right.
And so the market just that they wanted that news, right?
Instant
they wanted
exuberance.
The stock market shot up, mortgage prices came down. Everyone believed that this hawkish Fed governor or Fed chairman was committed to driving inflation down to 2%. And the fact that he felt confident enough, someone who had been so hawkish for so long, felt confident enough to say, we're going to have 3 rate decreases inside of this year. Everyone's like, we must have, we
turned the corner.
We've bested this beast. Right. Like, and then for the next several months, the inflation data came out higher than expected. And we're still there. And so he's started to back off and, hey, we're just going to pay attention to the data. And, nothing's ever set in stone. And with each new inflation print, which is a bit too high or higher than to be on target for 2%, the market, in my opinion, has lost faith that the Fed will actually be able to drive us down to 2%. And I think that those comments were, I've said this on a previous episode, a tremendous mistake because he had the plane coming in for landing and this nice soft landing to hit 2%. But then with those comments, he pulled up at 100 feet and we're just gliding over the runway right now and not going to touch down. In my opinion, not going to touch down.
And we're running out of runway.
Yeah, we're running out of runway. And I don't see us gliding into 2%. And so, he's got to jam the nose down or do another circle and try again in 2025, right? And circle back around and try again in 2025 to get inflation back down to 2%. But as a result, the mortgage market has lost faith that he's going to get there timely and has continued to price to keep rates up. And so we've seen that, unfortunately, in the mortgage market where I think, God, if you look at the 5-year Treasury curve, I was looking at it the other day, it was like this beautiful glide path down.
Yep.
And then ever since February, it's started to climb right back up to where it was.
That's
and,
right.
It's super frustrating. We thought that we were like past, it's been a tough couple of years from an interest rates point of view, right? Like everyone's tired of paying so much for money. Like everyone is tired of giving their lender all of their money, right?
Yep.
It's freaking annoying. We borrow a lot of money. So I'm tired of working for them too. But but I think that the issue is that now I'm not sure when we're going to get on a path to 2%. I don't believe that we're currently on a path to 2%. I think we're just gliding over the runway right now in anticipation of this election season. And I think that maybe once after we get past the election, there will then be the political will, because someone's got 4 years to sort things out, to then make the adjustments necessary, which in my opinion may include a rate hike. Like, everyone's still talking about 2 rate decreases by the end of the year. I'm personally, we're not getting anything this year. Maybe they throw one in, like perfunctory in the fourth quarter just before elections, but for political reasons only, and try to declare victory before the election, but then have to, as soon as they've won again, whoever it is, whoever wins, then has to actually do the hard work of actually getting us down to 2%, and we may have either flat or even a bump. I think is well within the realm of possibility. So I'm not a decreases this year camp guy.
Well, let's play it out, Jack. Let's say that between now and the election, we'll talk about whether or not there'll be an election in a second. But between now and the election, even if there was, let's say, 2 rate decreases, or frankly, I don't think there's going to be. So let's play the game with 1. It's always going to be a quarter, right? And so what would that mean? What do you think a 1/4 point rate decrease would mean for the average investor on Main Street? I'm a guy who owns 20 houses. I'm thinking about refining out 5 of them right now to get some cash out. Rates are sort of hovering in the low to mid 7s right now, and I think there's going to be a rate decrease sometime in October because we have a November election. First of all, I don't know if it trickles down to the 5-year, which all of these products are based on. But let's say that it does. What could possibly be the rate differential at that point, and how much difference is it going to make to the average investor?
Yeah, and that's the point. I think even if there's even if there's 2 rate decreases this year, I don't think it trickles down to the 5-year. I think that keep in mind what the Fed is adjusting. They're adjusting the target overnight borrowing rate for banks.
Right.
What banks can borrow at. Right now, I'm not borrowing from banks. Like, banks are so disconnected. Like, I even feel like the private lending and secondary market, like has evolved so much that banks are no longer as influential. They're not as influential as they used to be.
Absolutely.
Even 5 years ago, and especially 10 or 20 years ago. And so, like, frankly, I feel like the Fed is working with they're blunt tools that are also not sharp at the edges, right? It's like it's using a screwdriver that's stripped, and so they're trying to connect with the economy, but they just don't connect it. But the edges of their screwdriver are stripped, and they just don't connect with the economy through the Fed funds rate like they used to 20 years ago. So I think that's they've got a blunt, dull instrument that they're working with. So even if they did a rate decrease, I don't think that trickles through to Main Street. Like that's not going to affect that's not going to be a material increase to the profitability of Main Street businesses, a 25 or 50 basis point decrease.
Yep.
And so I don't see that really like having much of a stimulus effect on the economy, and I don't see lenders saying, hey, yeah, you know what, I'm willing to accept a lot less money for my, a lot less return for my money right now. Because Main Street doesn't feel like there should be a rate decrease, right? Like who on Main Street feels that like the economy is overheating right now? This is like a labor shortage driven, this is labor shortage driven inflation still,
Well, I also think that when you pump an additional $2 to $3 trillion into the economy over a few years, it's obviously going to have an inflationary effect. And we're living in this era of sort of finance capitalism at this point, which is always sort of the end era of, most developed, empires, which is, hey, thanks for listening, folks. Here's your good news of the day. It's not. And when we're adding, $1 trillion of debt to the national debt every 100 days now. I don't And so I was just reading an article last week where, Yellen is having a hard time selling 30-year treasuries. Nobody wants to buy 30-year American paper right now because they have no idea where the dollar is going. Even 10-year paper is difficult to sell. And that is why there's so much pressure on the 5-year right now, Jack, because the 5-year bid is cool. I can make my spread and I've only got risk for 5 years, right? And so I think that's putting pressure on the 5-year at this point, because nations are getting out of the dollar. And so, China's not buying any more of our debt.
I'm crazy to me. Like, it seemed like the return necessary to try to predict what the world's going to look like in 30 years. I think that becomes a very illiquid security, and that's not good for us.
We just don't have the balance sheet that we had in 1950 and 1960 and in the 1970, where we had a recession. We didn't have the balance sheet that we had today or back then to take us out of sort of the inflationary environment that we were in. We weren't, obviously an industrial society back then. We're no longer an industrial society. And so I think America just looks a lot different today. And we have, DC, who appears to have no lack of appetite to pass, a $7 trillion budget with a $2 trillion per year deficit. And so I just think that in terms of, breaking it down for folks that are listening who are either, advanced investors with large scale portfolios or guys that are just looking to, get up to 10 or 20 or 50. I don't see a material effect happening on interest rates by the end of 2024. None whatsoever. Don't see it.
Yeah, I don't either in the short term. Here's the silver lining, though, right? Like the silver lining for me is that I believe everything. I do believe everything that you just said, and so compounded with that is a demographic shift where we've got a lot of people who are leaving the workforce right now, and not a lot of people replacing them. And unless AI bails us out from a massive productivity increase point of view, which we're like, I don't know, really hanging our hat on right now, in my opinion, because we don't seem to be planning for any of these shifts. So we're really hoping that the productivity gains from AI are going to like bail our asses out of this situation. But if that doesn't happen, the only way to resolve that situation, those budgetary issues, is to inflate your way out of it. And so, right, though I think we're in a higher for longer interest rate environment, the best hedge on that is owning real estate. So like, I hate paying these rates, but I love what I'm using that money to invest in, because I feel like it's like the best hedge. If I'm going to invest in anything at these rates, borrowing money at these rates, it would be to invest in bricks, right?
Hard assets, right?
Yeah, hard assets.
And explain quickly why
to buy gold. Yeah.
Explain quickly why that is, Jack.
Just because of rents, because rents are inflation adjusted, and so if we have to inflate our way out of the budget issues that we seem to refuse to tackle, we're going to have increasing prices, and that'll pass through to rents. And residential real estate has annual adjustments for inflation through rent adjustments on an annual basis. So, sure, frankly, nothing is really better than houses for an inflation hedge. And so while it offends my sensibilities to pay our banks these rates and our lenders these rates, I keep adding rentals. It's harder right now to make the numbers work, because sure, debt service coverage ratio is tighter because of where the rates are. But I do feel like I've got like a nice put, right? So like if I buy this house with these rates, if I'm wrong, which would be great, right? If I'm wrong and rates come down, I'll refi and I'll achieve the lower rates. Sure. If I'm right, then I'm paying these higher rates, but I'm locking them in for a 30-year period, which I still think is a structural mistake. But that's the structural mistake that Wall Street's making, not me, not on Main Street. And I'll be able to increase. So if I'm right, and I get to lock in this interest rate, and rents are going to increase over time at a high enough rate that it will be profitable over time. So I feel like I still like bricks for this reason. Like that's still my favorite asset class to invest in. So
I agree.
We're continuing to add rentals as a result of that.
Well, folks, we appreciate you taking the time to listen to this quick hit. I'm Craig Fuhr with Jack Bevere. Thanks for listening to Real Investor Radio. We'll talk to you again soon.